Joining me now is Ted Thatcher, founder and president of Bright Lake Wealth Management. Ted, welcome.
It's great to be with you, Ashley.
So great to see you again and have you here in person. So as Dow coming off a record close yesterday, what do you think is going to happen in today's session?
You know, it's been a really green market this week. Obviously, all the excitement around SpaceX's IPO has continued into this week. And over the weekend, I've been calling this week basically the peace deal put in the markets. We got obviously great headlines about the U.S. and Iran coming to some kind of agreement here. It's set to be set to be signed, looks like on Friday. We're getting more and more details about that. We see oil coming down a whole bunch yesterday, obviously when the futures opened on Sunday. And this morning, we're seeing WTI below 80. And so this is a good sign for the markets. I think it's driven a lot of green this week, and hopefully it's a good sign for consumers as well.
We keep seeing the markets go high whenever we would hear news of a peace deal. Do you think it's actually going to come to fruition? And why do investors like this so much?
You know, I think it's definitely not the first time we thought we were going to get peace and, didn't get it, right? But the truth is I do think that there are more legs to this this agreement. The truth is not only the U.S. administration, the president has recognized this, but of course the Iranian media and the heads of state there have also recognized it. And so as the details have come out, it looks like there are specific concessions being made on both sides, especially financially by the United States. And so that's why I'm a little bit more hopeful this time, again, because there's a mutual recognition, actually.
And how do you think that this news of this peace deal will impact the Fed? They're going to come down with their next decision tomorrow. Largely believe that they won't change anything, sure. But do you think it's going to move the needle at all?
Yeah, I mean, honestly, Kevin Warsh is in the batter's box for the first time at the helm. It's really exciting. I'm interested to see exactly what narrative he takes. Ultimately, I think his first and primary goal is going to be to win the credibility of the marketplace. And so, some of this narrative around whether AI is going to be deflationary or not has been something he has put out there. I think that he would be wise not to dive into that narrative just yet. That may be the case that AI is deflationary, but consumers aren't seeing that yet. And he got a nice, I would say, slow pitch because of the peace deal. He actually has, I would say, some light at the end of the tunnel in the supply constraint that has been driving the cost of energy so high.
You talked about him gaining confidence from investors. What does he have to do in order to get that confidence?
Ultimately, I think he has to be data-driven here. At the end, consumers have been under pressure. We see it in all the headline inflation numbers. PPI at 6.5, CPI at 4.2. Obviously, the PCE number. It's been putting consumers under pressure. I think very thankfully, it hasn't filtered all the way through to the core numbers yet. But if he can recognize that and say, hey, we're going to now walk through what has basically been a bowling ball that's going through the boa constrictor of the economy with these higher energy prices, I think that understanding that, recognizing that, I guess, pain, and then kind of showing us where the off-ramp is would really win credibility with investors.
You talked about all these different data points, but what economic metric ultimately is going to decide the Fed's rate path forward for the rest of 2026?
Sure. Obviously the Fed deals with its dual mandate, right? It's going to try to keep unemployment low and inflation, in check. I think fundamentally, if we see inflation come down, that is really what's going to open the door to a potential lowering cycle. If we don't see that, I just don't think that there is a reasonable data-driven case for that to happen. Obviously we saw better employment numbers, 2 Fridays ago. That kind of spooked the markets a little bit. Good news ended up being bad news. And so if we see employment stay with where it's at, ultimately I think inflation is going to be the deciding factor.
And I understand you are paying very close attention to the state of the consumer. How do they play into this larger story? Yeah,
because of the inflation that we've seen for the first time in a little while now, a couple of years, we saw wages and inflation kind of go opposite. So inflation's outpacing wages for consumers right now. We know that, we can look at the consumer sentiment, the consumer confidence numbers generally have been near historic lows. So the consumer is absolutely under pressure. But what I also am looking at with consumers is not just that the sentiment number might be low, but I also want to look at certainly where their behavior takes us. So what are the retail sales numbers actually telling us? And so consumers may say, hey, I'm under pressure. Obviously, we're feeling the effects of inflation, whether it's at the pump or at the grocery store, but they are still, spending. They are still going out, living their day-to-day lives. And I think that basically tells me that the consumer is a little bit stronger than sometimes we give them credit for.
Right, and any advice that you're giving clients right now amid all of this well, it's a rally, but I was going to say choppiness, but we might be past it.
Yeah, people have talked about whether we might see a little bit of a pullback. Obviously, we've had a nice rally, and so investors, I think, need to be conscious about not letting, I would say, the fear of missing out, FOMO, being an investment strategy with names like SpaceX coming to market and so many things. We want to use the gambling term, chase it if we're not careful. That's not an investment strategy at all. I always tell investors to be systematic with their approach. Hey, if we want to get into a great growth company, I think that might be a good idea, but let's be thoughtful about it. Let's use the 30-40-30 approach. Maybe pick a time frame, maybe 3 months, 6 months, a year. Start with 30%. Halfway through that time frame, add the next 40%, and then, of course, add 30 on the back end.
All right, Ted Thatcher, founder and president of Bright Lake Wealth Management. Thank you for joining us.
Thank you.